All right, thank you for being so timely. My name is Kate Stillwell. I am with Neptune Flood. I'm the president of Parametric Insurance and also previously the founder of Jumpstart Insurance, which now exists within Neptune Flood. And I'm going to introduce our panel here because they are the people that are going to make community-based insurance happen. So we've been talking and hearing about community-based insurance and all day, and we're going to hear about it all day tomorrow too, but these are the folks that put it into practice. And on this panel, I want to inspire the people in this room to deploy private sector capital as post-disaster stimulus to the people who need it most. And this panel, along with the rest of the conference, is going to help make that happen. So that as said by, all right, help me out with his name here, your boss, Zach. As Zach said, to make sure that poor people get the money they deserve instead of preventing poor people from getting the money that they deserve. That's why we're here. That's what we're going to do, and this panel is going to help you figure out how to put it into action. Okay, so without further ado, on your left, from left to right, so Kathy Schaefer is really leading the charge in figuring out a framework for how community-based insurance is going to work in practice, has designed pilots to do so. Okay, Charlie Sidoti with Insure is basically has written the book about community-based insurance. He led a panel, the webinar with Carolyn, Dr. Carolyn and Helen about this last month or maybe 2 months ago. Deborah Halberstadt, right, with the California Department of Insurance, is the spearheaded the policy at the Department of Insurance that the previous panel made reference to in terms of what was the policy? The legislation about the pilots. Yes, exactly. And then at the very end, Joe Becker from Guy Carpenter was really the puzzle master in figuring out how to put all the pieces together for the New York project that we have heard about already. So I have a few notes here, and I'm going to try to keep the pace of this panel really quite clip. I noticed that half of you are already still out in the lobby here, and we might have lost a few because it is kind of the graveyard shift, but we're going to try to keep it pretty lively here. Okay, so Charlie, I'm going to start with you. Can you give us a sort of just the headline version? We're going to dive into what is community insurance, what is community, and what is insurance. But give us the headline version. When we say community-based insurance, what do we mean?
I think, thank you. Thank you for having us. Thank you to Carolyn. She actually wrote the book, by the way. Community, we like to call it community embedded insurance. We like to think of it as, one, you're insuring a community, so it's group insurance. And when we think about community, there's a number of different ways you can define what the actual community is. It could be an actual municipality, or it could be some other definition of community, which could include multiple communities, but delivering it through group. And some of the other characteristics of it that we like to think about is, how do you manage the risk transfer in a way that you're actually managing the total cost of risk, which, you know, considers mitigation and also considers recovery costs. So those are a few of the points. I tried to keep it short.
Thank you. Okay, so next, Joe, we're going to ask you to describe some success stories about how, at a high level, about how some of this community-based insurance has been put into practice and how it has made some payments. And there's 2 success stories that I think you're going to describe, right?
Yes.
There's the text on this slide is a challenge for those of us who are pushing 50 and need a little, are in denial about needing glasses. So if you can sort of keep it at a little bit higher level, that would be great.
Of course, and I've included some pictures to help everyone follow along. So introduction, Joe Becker, Guy Carpenter, and thank you, Carolyn, Helen, for organizing this. Fantastic. It's great to see so many brilliant people in the same room tackling the same problem, essentially. So just two real quick success stories that we went through to demonstrate Charlie's point that community is a flexible term. You know, most people think of, especially in legislation, it's either a zip code, it's either a census block, it's a municipality, but we can also think more broadly about that. We can think about maybe a collection of small shareholder farmers in Mexico, for example. And that's this project that we piloted last year. The goal of this project was to provide some type of financial protection against drought and excessive rainfall. So whenever there's a drought, whenever there's rain, that's going to impact crops. The people who are most disproportionately impacted are the ones who don't necessarily have the financial means to buy some of the crop insurance or navigate some of the legal system to receive some type of recuperation. So the goals of this was to reduce that protection gap that we've all identified, to enable quick and fast, seamless payouts to smallholder farmers who oftentimes aren't within the formal economy, and to implement this via technology. Most people, as was mentioned earlier, have a smartphone, have bank access, especially in outside the US, have bank transfers that are quite seamlessly done through the cell phone. And finally, to help develop a local insurance market. So one of the things that I think is a common theme that I don't think has been brought up enough is when these pilots get implemented within an individual area, it helps the private market kind of not only recognize that there's a need, but also, because you're quantifying the risk, develop some type of mitigation plans. And that's going to incentivize private markets in here. So the middle box is just a number of players who made this happen, and I'll talk about why that's important on the next slide. So this slide is what most people have heard about today. And we've had Tally speak, we've had Theodora speak, Helen's been a part of this, and Jackie's been a part of this. So I thought it was important to actually list all of the people, and this isn't to even account for all of the people on the ground actually talking to those that were impacted by the disaster. So, and NSF, as Carolyn always reminds me, you have to thank NSF when we come to this, because they were the funding source of this project. So it was funded by NSF. It was awarded to Carolyn and Helen, EDF, SBP, the community aggregator, Center for New York City Neighborhoods. The advisor was Tally's group, Mayor's Office of Climate and Environmental Justice. We helped broker the deal. Swiss Re provided the capital, and the data provider was ICEYE. So why this is important is, I think it's a common theme that we've heard on this. There's a lot of people that have to come together to be able to think through these solutions and make them work. And that's going to be one takeaway, is that you can't do this in isolation. You have to loop in all the people all the stakeholders that, even if you don't think are directly applicable, they have to be at the table because it's ultimately going to influence them. In terms of how it was actually structured, it's actually fairly straightforward. The community institution is the group that is actually paying the premium to the reinsurer. In the event of a disaster, the claims would go from the reinsurer to the community organization via the ultimate beneficiaries via grants. I think that has been fairly well explained by people far closer to that part of the process than me. But I did just want to emphasize that there are a lot of people on here, and it's helpful to kind of just see that on one slide.
Yeah, super cool. Thank you. Kathy, I'm going to turn to you now. You've developed a framework for community-based insurance that's repeatable, affordable, and scalable. Can you just walk us through that?
Sure. I want to just kind of start by suggesting that in 1978, Howard Kuhnruther, I'm not going to say that right, I've tried 3 times, did a study on why is it that people buy flood insurance, what influences the purchase of flood insurance, and he found that there were 3 overarching factors. Number 1, that it had to rise to a level of concern. Number 2, their neighbor buys it. And number 3, it has to be affordable. And my research focuses on California, but I would argue that in California, that is what drives everything in California. If you look at the data for us, our policies have declined every year, except for one, the year of the Godzilla El Nino. And it has, 4 years later, we're back to where we were. The second thing we have is in Sacramento County. Sacramento has gone out to their voters 3 times to ask them to assess themselves for fees to improve the levies. And 3 times the message has been, pay us a fee, we're going to work to improve the levies, but we will never get you out. You will always have to buy flood insurance. And in California, 1/3 to 1/4 of all policies are written in Sacramento County. And then the third was that it has to be affordable. If you look at the policies, the policy data for California, half of the policies are discretionary policies, policies that people choose to buy. And if over the long term, you see the trend that even as the price has gone from $350 to almost $800, the number of policies has stayed constant with time. Get above $800, you see the exact opposite, that as the price goes up, the number of policies go down. So I think there's 3 things that we want to think about. And then we add to that the work from Carolyn. Carolyn says that insurance is a bit of a Goldilocks arrangement. You have to find the right set of combination, and I think that holds true. And then the 5th thing we want to think about, I think, is what we've talked about recently, just about the fact that there are some people who can't ever buy flood insurance or who may never buy flood insurance for a variety of reasons. And so whatever program we put together, we have to think about those. So with that framework, what we have is what we're proposing for a small pilot project in the heart of the Delta of California in a little town called Ileton is a 3-tiered program. The first tier is what we call It Takes a Village tier, and the idea behind it is that everybody pays a little bit and everybody gets a payment, likely to be a parametric product right after the disaster. We're targeting $10,000 so that it can be used as the deductible. Then the second tier, the tier is a traditional insurance tier, and that tier is targeted to be whatever $800 or a maximum of $500 to $800 can buy you. So something that we think is attractive to the general population. And then tier 3 is sort of everything else. I call it the concierge tier. I don't know if you're familiar, but in California, where the high cost of living is that we have healthcare providers that if you want to see your physician within a year's time frame, you can pay extra to get a concierge a policy, so you can see your doctor like in a couple of weeks. So it's the same kind of idea. It's sort of everything that the community might need to help them recover. It could be that extra $100 to $250 to meet their NFIP requirements, or it could be something broader to cover some of the needs of the community. Next slide. And what I think what makes it possible in California, where we may have some differences to other areas, is that the studies for us show that 80% of all of our losses occur with atmospheric rivers in category 4 and 5. And for those of us, for California, we are experiencing climate whiplash. So we go from drought to flood. And so there's a real emphasis on trying to keep and store the water that is in the category 1, 2, and 3. That's our water supply system. And in fact, just yesterday, the governor announced a $300 million program to try and capture more of that water. So what that means for insurers is that we start to understand more the path of when we are going to have or likely to have losses. The challenge that we face is that all of these are on different timescales. The data shows that the homeowner is likely to buy flood insurance and keep it for 4 years. The atmospheric rivers happen on a decadal scale. We had major floods in 86, 96, 2005, and 2017. So it's a decadal timescale. And then you have the reinsurers who deal with 1-year timescales. So one of the challenges that we will face is trying to figure out how we make these timescales work. But that's the framework that we're sort of proposing. Thank you.
That's great. And Deborah, speaking of frameworks, tell us a little bit about the policy that has been pushed through recently.
Happy to. Thank you so much for having me today. Before I jump into AB 970 and our pilot projects, I just want to, it's helpful for me to have kind of a touchstone of why I'm here. It reminds me of when I was getting married, and it was like, we're not getting married because we want to choose between white and champagne colored tablecloths. We're getting married because we love each other. And so like here, I want to remember we're not talking about community-based insurance because we want to get into all of the nitty-gritties of insurance, but because we're really trying to build resilience. We have a planetary crisis. It was announced yesterday that we have now bypassed 6 of the 9 planetary boundaries that exist, and we have a social crisis. If you're familiar with Kate Raworth's work on donut economics, it's kind of like this concept of the rings of life. You have to operate within your planetary boundary, and you can't let people drop through the social boundaries. And so that's kind of what drives me and how I approach the questions that I'm looking at. And so with the California Department of Insurance, we've been trying to grapple with these massive questions. I mean, if you think back to March of this year, we had huge atmospheric rivers, massive flooding, and the community of Pajaro, which is right it's in Monterey County, kind of not quite adjacent to the ocean, but very close, and its levee burst. And you had these farm workers who work in the strawberry fields, who tend to be immigrant farm workers, often undocumented, often don't speak the language. They lost not only their homes that they rented, but they lost the strawberry fields that they worked in. They lost their transportation. They weren't able to get where they needed to go. They couldn't get to safety. And so this is kind of the place that we start from. How do we protect those people? How can we use insurance as a tool to build resilience and to enable these individuals who now have to evacuate, leave their homes, leave their work? What can we do to help them survive in the future? And so with AB 970, we are creating a a grant program within the Department of Insurance that, if funded, will be able to provide dollars to certain jurisdictions within the state that are really focused on community-based insurance, nature-based solutions, and innovation generally to build in these protections for these low-income communities. So Len, with One Shoreline, is one of the entities identified in there. Ileton, that Kathy's been working with, is one of the entities identified within there. There's several more. And we're really hoping to focus not just on flood, which you've heard about a lot today, rightfully so, but also extreme heat, because at the moment there is no insurance for extreme heat. And so we're really thinking through how can we use insurance as a tool to enable local governments to adapt and build resilience, or enable, elevate nature-based solutions in the space of extreme heat. And then we're also looking, not surprisingly at all, at wildfire. We're really focused also, just one more point, on the climate resilience district. So last year, Commissioner Lara sponsored legislation to allow the creation of climate resilience districts in the state. And what we're hoping is that some of these pilot projects will take up that concept as a mechanism for defining community as a climate resilience district, and then be able to use that insurance broadly, if they decide to purchase insurance, to use that insurance broadly to address climate across the board.
Wow, super exciting. And it's like building on all of the comments from the previous panels. Charlie, I want to turn back to you and ask, how come this isn't already happening? What are the challenges that have yet to be addressed?
Oh, my God. I think you've heard a lot of the challenges throughout the day. Who's going to pay for it? How do all those people that Joe talked about get together? And each one of them is, there's a large permutation of pieces of the solution that need to come together for every community differently based on the perils and the time horizon and the thing that Kathy's talked about. So it takes time. I think Carolyn started this morning, she talked about this is really the beginning. There's been a few pilots, and Janelle was talking about 20 pilots. That 20 pilots needs to go from 20 to 40 pilots to 80 pilots. And that's how innovation happens, because you have to match not just the solutions to the problem, but you need to do it locally and figure out, and there's a different problem in every community. So the pace of innovation needs to accelerate, but all the solutions are in this room, and I'm super optimistic that that's already happening and excited to work with a lot of people in this room to make it happen.
That's great. Sounds like what you're saying is applying basically the sprint mentality of startups to design experiments and then learn from them and then build bigger and bigger projects so that they can be more scaled.
Yes, the world that I come from is more the startup community, quite frankly.
Oh, okay.
And that agile approach, it's super exciting to see. I was telling the panel at the beginning of this is a very academic audience, a world that I'm not always in, but it's super exciting to see that it's the most applied focus of such an academic group. So kudos to you guys for putting this together and keeping the agenda applied to get some actually fixed. We love it.
Putting theory into practice. And so, Joe, being a practitioner, let's fast forward to when all these pilots are at scale. What do they look like when they're sustainable at scale?
So that's the million-dollar question, right? So I'd like to start by, when we think about a pilot, there's two different aspects of the pilot. There's the capacity building, right? There are the salaries of the city workers to kind of get around a table and say, what's the solution? Who doesn't need to benefit? What are the mechanisms for distribution? So that's the one aspect, right? And there's an existing host of grants that aim to solve that portion. The more difficult problem, and we've heard it throughout, is how do you make it sustainably financed, and how do you find dollars for premium? And I'd like to think about this in like a 5-year trajectory, right? We've had success through, frankly, grant dollars to be able to fund some of that premium, but ultimately, those grants need to transform into something that the city can ultimately absorb within their budget, right? Whether that is through a series of different donors, moving from grant to donors to municipal finance, or whether that takes another approach. Ultimately, the residents of the community are going to have some stake in this, and there's value in that, right? So when you think about risk transfer more broadly, and I'm going to use the word risk transfer rather than insurance, because ultimately when we think about a specific community, it may be that insurance is not the most efficient way to actually transfer that risk into the private market. It may be a different financial instrument, right? So I think we do need to, as Deborah said, talk about resilience and not specifically about insurance, right? Because there's some practical implications about that. But when we think about risk transfer, we think about three things. And as an industry person within the insurance industry, I'm going to advocate for our industry. When we transfer the risk, we quantify the risk, right? That's first and foremost. When we talk to communities, oftentimes they haven't quantified the risk, or they've done it in a way that only satisfies the FEMA grants and not necessarily the private markets who might need to come into it. The next is when you quantify it, you're able to start to prioritize mitigation efforts. You're able to say, these are the communities who will have a disproportionate view of the financial risk if an earthquake, a flood, a fire, a hurricane happen. And you're able to funnel dollars to either do the hard infrastructure or the financial infrastructure to be able to support that. And finally, the benefits of that risk transfer is that it provides a mechanism for recovery, right? And ultimately, that's why we're here, is to help those communities recover faster. And the aim around this is to ultimately make that disaster that is going to happen. We all recognize a hurricane is going to hit Florida, right? We're ultimately make that disaster a budget item within a municipal budget, because they're already paying for it, and it's been said earlier today, they're already paying for it, but they're paying for it in shocks. And frankly, the way that funds are distributed from federal and state levels disincentivize some of the communities from being able to incorporate that into their budgets, because they'll sit back and say, we're going to get FEMA dollars, we're going to get state dollars to help rebuild. But that's unsustainable, right? The goal is really to transfer that risk to is for the municipality to have a say in that risk, and ultimately that is via risk transfer because it does quantify, allows them to mitigate, and ultimately recover via the private market.
All right, so what I'm hearing is that ultimately, in like the steady state, the everybody with skin in the game is going to be the ones paying for it. But we really need to think more broadly. I'm going to advocate that we need to think broadly about who has skin in the game, not just the individual residents, not the cities, but also the foundations, the philanthropy, and the very importantly, the businesses that operate in those communities and who depend upon a thriving economic environment within that city to be able to, to have their workers and to have their business operating. They have a ton of skin in the game to make sure that the community at large does recover. So I want to move on to thinking about, okay, what does community and what does insurance mean in community-based insurance? And so, Joe, you mentioned a few minutes ago, I'm going to stay with you just for a moment because in a couple of moments ago, you mentioned the protection gap. And actually, this notion of the protection gap, although maybe a lot of people in this room are familiar with it, hasn't really come up on the previous panels. So why is it important to be able to do community-based insurance at scale? What does the protection gap mean? Who are we serving?
All right, I'll start and I'll let Carolyn correct me about the technical definition of the protection gap. But in essence, it's the difference between the economic loss and the insured loss of a disaster, right? The economy experiences a large financial shock, and a portion of that is ultimately insured. So that is typically what's defined as the insurance gap. And there's probably iterations, or the insurance protection gap, and there's typically iterations.
So we're talking about people who don't buy insurance, or is there more to it than that?
There's more to it than that. I was debating whether I go through that lengthy explanation of like quantifying different elements of the insurance gap. I think I'll do it in 3 different stages. There's individuals, there's communities, and societies, right? Individuals, this can happen in lots of ways. It's people who don't buy insurance, right? That's the easy one to think about. There's more of a, that I think has been brought up with potentially raising deductibles. So if anyone has a coastal home, let's say in Florida, you're familiar with a percent deductible. You know, your deductible is not a fixed amount. It's a percent of the replacement cost value of your home, right? Sometimes, especially on coastal homes, that is a significant amount of money. You think Florida, you think a lot of retirees, a lot of people on fixed incomes. They often don't have $30,000, $40,000, $50,000 in disposable income if a hurricane happens to actually contribute towards that deductible. So there's a gap between where their insurance kicks in and where they have the the liquidity to actually respond to a disaster. That's the individual sense, and there's dozens of different permutations that we can talk about, like where we don't see adequate coverage. When we think about communities, we start talking about some of the things that have come up. A loss in a tax base, the ability to for businesses to get in and pay their hourly workers faster, right? So all of those are typically not within a standard insurance contract, right? But I think we can all recognize that they contribute to the economic decline if they don't recover fast enough. And finally, if you start to group all of those communities together, you start to see some of the societal impacts. And I was talking earlier about the difference between a U-shaped curve and an L-shaped curve, and this is exactly the societal recoveries that we're trying to prevent against that L-shaped curve. We want to be able to provide financial support for individuals, communities, and ultimately societies to recover and get back to operating and not necessarily business as usual, but business in a more resilient way.
All right. Thank you for that. And Deborah, I'm going to turn to you next and say, just let me clarify. It's not that the community-based insurance is necessarily trying to get people who wouldn't otherwise buy insurance to buy insurance. It's to be able to get liquidity out in the community deployed, whether or not it's classified as insurance. And we'll get to the insurance question in a second. But first, staying on this topic of who is the community, who should we be serving, and how do we reach the people that we want to reach?
Such a good question. And I think that it goes to talking to the communities themselves and understanding what they see as their fundamental needs and where they see needing the most assistance. So I think, it can really vary. You've got the New York example that we've heard a lot about. where it's like low and moderate income households and homeowners. Or you could be looking at, in the case of extreme heat, which is less property loss driven, maybe it's the local government that is actually needing the assistance to be able to deploy resources quickly to prevent the worst acute impacts of heat. If it's with the example I talked about with Pajaro, where it's renters, undocumented, it's like that's a totally different animal. And so I think defining community is up to the community. And it's our job to understand their needs and try to meet them where they are.
Another good question. What we have kind of proposed for the town of Ileton is that in California we have, you heard it mentioned earlier, we have what's called a geologic hazard abatement district. And it has unique properties in that you can draw the boundary however you want to draw the boundary. So in the case of Ileton, we've drawn the boundary to be, at this time, coincident around the city boundaries. But the governance structure allows us to add on other areas. And in California, one of the big challenges we have with the NFIP is that we have a lot of what's called census-designated places, where they're unincorporated areas. And we have several small communities along the Sacramento River that are what they call legacy communities. They're census-designated places. And the idea is that once the pilot gets up and going, that there will be an opportunity for these smaller census-designated places to kind of add on and to grow. So we're thinking of it being a very flexible arrangement, one that can meet the needs of the local area.
Okay, that's cool. So like in Sausalito, for example, there could be a geological hazard assessment district that's one valley that could be a landslide, and then another geological hazard district that's just along the waterfront that's going to have the sea surge.
That's right. And to take it a step further, along the Bay Area, we have, they've identified what they call landscape operational units. And so one idea would be that there's maybe a GAD for each landscape operational unit, or there could be one GAD for the total sum of the landscape operational units. However, it makes sense for the local communities and what seems to work for them.
I'm going to throw in a ringer question, Charlie, for you, which is still staying with the idea of how do we define community. Are there non-geopolitical ways to define community, like, for example, of affiliations?
Oh, absolutely. I mean, the whole life, health, and benefits insurance industry is built around employers, and they have a very effective model at delivering group insurance to the world and micro insurance as well. And so there's a natural way to bring the two halves of the industry together to work together to deliver through employers. But the notion of group is really only limited by our imaginations, and we can figure out a lot of different ways to do it. I think some of the key things that Deborah was talking about is, you need to engage the community to define what makes sense, because the community is really about kind of people who engage together in different ways. And part of that is what Joe was talking about. The insurance industry has tons of analytics, so they look at it the way Joe described, individuals, communities, economic loss, insured loss. You can take those analytics and present them in a different way to different groups and then help them make better decisions because they are better informed about the scope and the nature of the risks that they are facing over long periods of time and across multiple perils. So I think there's a lot of different ways you can do it. The community has to be involved, and they have to be informed in that decision-making.
The loop of stakeholder engagement that we were hearing about from the
Yes.
last panel. Charlie, I'm going to stay with you now on the next piece of this. What does insurance mean in community insurance? And we already heard from a previous panel, and we don't have to go over it again, about the mechanics of what the definition of insurance is and some of the challenges about categorizing these community-based insurance under the insurance rails. And without going into that again, I want to ask Charlie, what are actually some advantages beyond the mechanics of the categorizing these community-based insurance as insurance? What are some of the like softer and intangible advantages of having these be considered insurance per se?
I think, so, and you can even define insurance different ways, but having actual insurance where people have policies, and I love the way the group, the Life, Health, and Benefits works. The individuals get policies, and I know there's a lot of different ways, and I think the intermediary with the nonprofit, it certainly works in a lot of communities. But the closer you can get to the individuals, we think makes it more sustainable because they have a more tighter stake in the process. And it kind of gets back to, I have a piece of paper, I'm insured. If this happens, I know exactly what I'm going to get. The farther you get away from the individual, the murkier it gets. Not that it can't work, and it's probably better for some communities, but having insurance that pays out, and then when the payout happens, I don't know where it was, so it's one of the panels, it truly is a magical thing. That when the payout happens, especially when it's within those 24 hours and it floods into the community, it makes a difference.
Here's your token. You are entitled to this payout. This is your thing, and you can keep it in a frame or wherever you want to.
And for those things to happen, it really does get back to the stakeholders understanding, like, what is insurance? How does it work? How is it going to work specifically for me in this situation, and how won't it work? And it's not easy. I think we all know that, but.
Yeah, I can tell Joe wants to say something here.
Well, just one thing to mention, because, as we go through this, we always talk, like, it sounds fairly straightforward. There's people kind of saying similar and adjacent things. But it's important to recognize some of the technological changes that have allowed for some of these different applications. So, as Charlie mentioned, one of the projects that we mentioned in Mexico, that is direct to consumer. And we're able to do that through tech platforms. And actually, Jonathan at Raincoat was one of the partners associated with that. So there's some flexibility around here, to tailor solutions to specific communities. That's all I wanted to mention.
Yeah, Deborah.
So I just want to push that a little bit and understand actually in the context of parametric insurance where you have specific triggers and it's binary, right? You either meet the trigger or you don't. I mean, you can have index, but at some point you meet the trigger or you don't. Communicating that to individuals, I think, is actually very tricky because they are paying into if you have them paying into a system with an expectation that they are going to get a payout and it hits like 101 degrees but not 102 degrees, or it hits some water level but not a total water level that they need to reach, then you have very unhappy community members. So I do think it's important to be careful when we're talking about these solutions, that it's not just kind of easy. And for this reason, I tend to default a little bit more, in contrast to what you were saying, Charlie, I tend to default a little bit more to the more sophisticated purchasers of insurance, like the local governments or like public health agencies or something like that, as opposed to the individuals, just because I worry that with the insurance literacy issues that we talked about earlier today, parametric insurance is like a whole different concept, and that can have kind of impacts that we don't want to see. So
I think that's a fantastic point, and it highlights the need for clear communication across everyone within that ecosystem. I think, where I'll push back a little bit is, there is a point where there is a payout versus not a payout. But there's opportunity when we look at either different data sets or different structures to be able to minimize that point where there's absolutely no payout when people think there should be a payout, right? We've seen microinsurance, work quite well in many parts of the world, and it operates on a very similar basis. What makes those programs successful is that there's clear communication, and then there's feedback and there's input from the ultimate policyholders, and making sure that the ultimate program that's implemented is going to fit their need, and there won't necessarily be that pushback when you have that 100-degree day and not that 101-degree day. So, I mean, I think it's incredibly important to highlight the need for communication to the ultimate beneficiaries.
Go ahead, Charlie.
And yeah, I agree. I mean, the communication is critical. Parametric too. Parametric's an amazing tool because we have these really acute problems right now that parametric can come in and fill some big gaps quickly. And in a way that really makes lives better, especially for more vulnerable communities. But it's not going to solve the whole problem, and it's a piece of the pie. And if people are like thinking it's going to solve the whole problem, it's not. And that's when people are going to be really disappointed, like, what? So it can't be oversold, but it also, we should deploy it with kind of in an aggressive way where there's these acute problems that can be solved quickly.
All right. I had a game that we could have played if I saw more people falling asleep, but the whole audience is awake. This is the first time I've been at a conference where at 3:45, the whole audience is awake. So we're just gonna keep plowing ahead and I'm gonna give Kathy this magic wand and ask her not to flip the slides forward because it goes to the game. And use your magic wand to create the perfect and ideal community-based insurance program. Don't actually touch any buttons, just like wave it around like you're the fairy godmother, okay? And so who specifically are the beneficiaries? I know you already have someplace in mind, so you already have a magic wand, but let's think about it even like bigger. Who are the beneficiaries? Who are the parties involved? Who pays? How does it get deployed? All of that in 30 seconds or less. No, just kidding. I can't. I don't have the magic wand. You have the magic wand.
Well, if I have the magic wand, so I'm biased to California, so my magic wand covers all of California, my magic wand has it so that every household knows that they will get, if under certain conditions, if we have an atmospheric 4 or 5 that's hitting the coast, they know that they will get a payment if their home floods. So this sort of already know that you're going to get some amount of money. Then my other magic wand is that insurance is that you can get at least $100,000 policy for $500. And that's going to mean that we're going to have to really hone in on what is the load that the insurers get. There's going to have to be maybe some give and take. There's going to have to maybe be some backfill by the state government to kind of augment that because they may not be able to work, the numbers may not work without it. And it's a collaboration that everybody knows. And then Tier 3 is a program where there's funding for the community to recover. I think about Pajaro, and it breaks my heart that we have people who are still today living in hotels because they can't find a place to stay. And so it may not be totally insurance, it may be a combination of a lot of financing things, but if I have a magic wand, no one is still living in a hotel 6 months after the disaster happens.
Can I wave the magic wand?
You would make a great fairy godmother. I think Disney needs to use you as a prototype.
Okay, I'm down for that. I don't know if the kids would like that, though. If I had a magic wand, I would imagine that the community-embedded insurance market is like a $500 billion market, and the protection gap is cut in half or better.
Oh, okay, that's cheating.
All right, my magic wand is less powerful than yours. My first wish is that I would get funding for my pilot projects.
That's step one.
That's step one,
on
right?
my magic
I've
wand.
got AB 970. I just want my budget. But that said, I think I really strongly believe in focusing on the most vulnerable communities and those populations that are currently uninsured because they can't get insurance. And so my magic wand would be that they would have access to immediate payouts after a climate disaster, and that they could avoid the worst impacts of that disaster and then recover quickly. And I would want to pair that with nature-based approaches that reduce risk, but also that regenerate nature and regenerate our ecosystem so that when we're not just focused on human well-being, but that we're focused on the entire planet, sort of recovering from how we have poisoned it so far. And that these we would be able to demonstrate the value of protecting these communities quickly, and we could scale them up immediately.
All right, Deborah, before you pass the magic wand, so speaking of who's going to pay for your pilots, which party or parties have the most aligned incentives for the outcomes that your pilot projects will achieve?
I think that there needs to be partnerships, public and private. I think that there's a role for the state. Certainly, I think it would be beneficial to do some sort of cost-benefit analysis of the social services costs that would be avoided if there were subsidization, like means-tested subsidization of some of these insurance policies. I think that would be a very simple kind of way to start looking at those questions. And then I think that there's a lot of private entities, companies, like you were saying earlier, the companies that operate, businesses that operate within the communities that benefit from having a thriving community. I think that there's on all scales. But I agree with Nicholas that I don't think we should have the bill for these particularly vulnerable low-income communities. I don't think they have the resources to be able to do this on their own.
Right, okay. I can tell Kathy wants something else to say, but let's pass the magic wand to Joe, and I will get back to you, Kathy.
All right, so I'll try and make it quick because I think the previous panelists have outlined a strategic implementation that all makes sense. So I'll take a more tactical view, and I'll say my ideal project is one that gets done, right? We're all here, we're all talking about it, and we'll all continue to talk about it for a long time. But that only takes us so far. Unless they actually get done, unless they get funded, unless you get support from your community members and build equitable solutions, like, it's all talk. So I'll take a very tactical approach and very broker-minded approach, frankly. They need to get done for them to actually provide good for the people.
So I want to add to my magic wand, because I forgot one. There are two books that I believe that every floodplain manager needs to read. The first book is called The Feminist City, and spoiler alert, I don't believe that the word flood is anywhere in there. But the book talks about, what if we imagined our cities designed for moms? How would that change the character and the way that our cities are arranged? The second book is called In Too Deep, and it is a interview of moms after Hurricane Harvey. And what comes out of the book is that moms are the family logisticians. They're the ones who, after the disaster, are the ones responsible for filling out the insurance forms, getting everyone and keeping their family together at the same time. So if I had a magic wand, whatever we do, however we move forward, it would be for the moms. And I would also say that it's not just people moms, it's fish moms, turtle moms. And I think we should think about how do we insure fish, because that's part of it as well.
I'll just say there are parametric products that help insure fish. So.
Wow, okay.
School embedded.
With that, audience, your turn. What's your magic wand, and/or what questions do you have for the panelists? I'll take a stab at that. And if you guys don't want to, anybody want to jump in on that one?
I mean, I think that's an excellent point. I don't have a good answer to that right now, but I would be really interested in talking with you about it further.
Maybe I'll answer then.
Sure.
So I think one of the benefits of working in an insurance ecosystem is that you get to see the entire process. You have people to help support, when you're talking with the community, help support you through the entire process, right? From the exposure identification to the risk quantification, through the mitigation strategies, through the accessing the markets, through the structuring, through the potential knock-on impacts that you might have from maybe a diverse set of reinsurers or ILS funds that help support all of this. So I might take a different approach, saying, as long as the consumer is there asking questions and being proactive in doing that, we want to make sure that we don't necessarily limit the ability for them to engage in this type of recovery initiatives, right? I completely hear and completely agree that there needs to be safeguards to make sure that people don't get taken advantage of, but at the same time, there needs to be a balance to allow them access to some of these funds. We already have some of the, and this kind of gets into that wonky discussion of, if it's an insurance, it's either a regulated product or not, and you have to go through like the Department of Insurance to actually have a look at it. If it's not, you can go through the SEC and buy a weather derivative. At the basic, that's what it is. There are different implications when you go through that, where you have like a Know Your Customer. You have a mandate on the required liquidity to be able to support that transaction. So, and that's one of the excuse me, that's one of the reasons why I want to raise above the idea of just community-based insurance and really think about community-based solutions, because there's a wealth of opportunity to be able to provide that type of support with different instruments.
All right, so this goes back to 2 points. One is the point Charlie made, which is this agile approach of starting in something that's really achievable so that it gets done instead of perfect. But at the same time, going back to Kathy's idea of when we think about rolling this out at scale, there needs to be this thinking about what is the governance and who is the body, which we didn't really get to too much in the panel discussion, but who is the governing body that organizes all the parties and makes sure that it happens and makes sure that the risk gets pooled. And so I'm going to give Kathy the last word before we close up and transition to the next panel on the governance of these types of solutions.
That is the thing that has surprised me the most in my research. We have a governance gap. We have lots of pre-disaster mitigation, but we don't have any funding, and we don't have anyone whose job it is to do pre-disaster recovery before the disaster. And because we don't have a governance entity focused on disaster recovery before the disaster, we don't have funding for that kind of activity. After the disaster, there are 41 different programs that are available, but before the disaster, nothing, zip. So that's my word. Pre-disaster recovery planning governance.
And with that, please join me in giving a huge thank you to our panelists.